Hey everybody, how we doing tonight? Great. Guys can see my screen okay? All right, perfect, great. Nice to see everybody in here. All right, let's do this. Welcome everybody to the second quarter of 2022. This is Steve Morrow's regular DMR session for Wednesday night. Okay, so we know where we're at. We know this is done. I like to cross this off so you can feel a sense of urgency. You know this is done, and you know we are already sitting at April 20th. So we're 2.5 weeks done in the second quarter. So that should give you somewhere between 10, 9.5 weeks left. It's time to get going. All right, so you got a couple weeks here, and then we got 2 more months, and we're targeting July 1st as the end date for the quarter. All right, so waiting for some maps from some people, some plans, some layouts. You know who you are. If you told me you were going to do it, I'm still waiting. All right, so 12-week year. I've talked about this book nonstop for, I don't know, since 2014. It's just to add some structure to your business. Listen, you work for your boss. He tells you what time to show up, what time to go home, what days he wants you there. You work for yourself. You got to be a boss to yourself. You got to do the same stuff. You got to structure your day. I talked about this field guide. Only 2 or 3 people picked it up. That's okay. But if you're lacking somewhere, this is to help you get, I guess, to add some context to the structure. All right, these are some alternate books that you should be reading. A lot of us have already seen these. This Trading in the Zone is a really good book. And it's great on audio. It's, I don't know, it's just something you can listen to over and over again because you hear it differently every time. And the more you're involved in the market, and then you go back and listen to it, the stuff becomes, I guess the right word is, more and more applicable to day-to-day activities. All right, everybody good? Okay, so we're going to get right into email and charting today. I'm not going to talk about the motivational stuff. A lot of you burnt out on that. So we'll just go right into it. All right, email, this was sent to me. One of the guys is trying to qualify. He's overseas. I don't know the name of this platform. It's Alveo maybe. But here's the situation. He needs to make his trades on their platform. He can only get the EMAs on there. So he can't, the indicators won't load. It's probably not MT4 or it's locked to their stuff, whatever the reason is. So the question is, how can he trade? How can he make this work? And it's really an easy fix. So there's only a handful of brokerage feeds, right, from the market. Can't remember them all, but there's like CQG. There's different companies that provide feeds for these platforms. So what you need to do to make this work is to find the feed that closely matches the feed in Alveo. So what you need to do is open up 2-3 different demos in your jurisdiction, right? Because if your part of the world should have the same vendors available to anyone that does business in that area, right? It might be a feed out of Chicago, it might be a feed out of New York that's reprogrammed over there and fed to the demo accounts over there. So open up a couple of demos and put them side by side with Alveo. Try to find the feed that matches your feed, price points, highs and lows. You'll know pretty quick. Just open up and look at the blue tracers and then compare the highs and lows and the opens. You'll have a rough idea. The open will be a little different depending on when this guy, like if this dealer opens at 4 and the one you're demoing opens at 5, then they're going to be off by whatever the difference is between 4 and 5 in the movement of price. That's okay. You can work around that. You're never going to get it exact because they have their own plugin managers, their rollover time, settlement times. They're all going to be different. But the idea is to get something that moves just like yours, right? Then you could basically apply the template to the MT4, trade them side by side, but execute in the platform that you're trying to qualify under. So that's it, simple. Okay. The next part of his question is a little more challenging. So he is trying to figure out a way to add consistency, right? He's trying to, I think he meant profit from last 100 wins compared to last 100 losses. I hope he's not having 100 losses. I think he meant 100 block a trade. So compare his win-loss ratio to the last 100, to the current 100. Right? He needs to maintain a positive expectancy. That means that he's trading profitable, and the expectancy, what he expects it to come out at in net positive or whatever. All right, so he's working along, he's having some problems, but he's trying to figure out a way to become consistent. And you guys ain't gonna like the answer, but it's just the way it is. Right? Consistency comes from being consistent. Yeah, right, I know. Okay, Steve, yeah, wait. What a revelation. That's it. What is it? Stop the presses. It's just the way it is, man. You have to behave the same way every day when it comes to trading. Listen, everyone, the human body loves routine and it loves consistency in meals that you eat and things that you do and the way you take care of it. And whether you realize it or not, you have a routine. Maybe it's a good routine, maybe it's not such a good routine, but you have one. So for trading, how that applies, and listen, I've lived this stuff firsthand. I figured it out over the years. You guys know I'm a little bit older. I've been in the business almost 20 years. So just trial and error and living through the stuff. You guys that are younger, they're just getting started. It's just, you got to figure this out. The sooner you figure this out, the better off you're going to be. You can't stay out all night on a Sunday on a bender and think you're going to wake up Monday and trade. It doesn't work like that. So how do you become consistent? First, you got to become consistent in your behaviors. That's wake up same time every day, eat, exercise, same stuff every day, roughly, right? Don't throw any curves at your body. Show up at the office, same time every day. Maintain the same hours in the office, 1 to 5, 1 to 8, whatever it is. Midnight to 7, it's got to be the same. You got to apply the same rules to trading every single day. Whatever your entry rules are, you got to apply them the same. Same technique for execution, same technique for backside management. Maybe trade a smaller number of pairs every day, same pairs. Can't jump around. The pairs have their own personality and behavior and the way they move, the way they trigger their stops, the way they widen the spread. All that stuff is inherent to each pair. Some pairs hit the stops with a 30 pip move, some pairs hit the stops with a 50 pip move. You got to back end manage the trade the same way every trade. Whether you use a robot, script, move to break even, the same every trade. Take profit, same every trade. Cut the trades under the same conditions every trade. Avoid the same news releases every month for every trade. If you don't feel good that day, you feel whatever, emotional, you stand aside every time. If something's going on with you, it's just these little behaviors that are going to make a big difference. This stuff goes a long way. I didn't realize how important it was because the guys that have been with me for 10 years or a while, have been around, I hate all this crap. I used to hate it. But as I started teaching people and meeting people and finding inconsistencies in their behavior and their patterns and things that were going on, some of you have been with me a long time, so you know what I'm talking about. I used to like journaling and like, I used to make fun of this stuff. It's in my old videos. I didn't believe in this stuff, but I was trying to figure out how to help people. How can I convey the same information to a group of people? Some people trade it outstandingly, some people trade it mediocre, and some people can't trade their way out of a paper bag. I guess a wet paper bag is the way the saying goes. So I tried to figure out, what am I doing as an instructor, as a teacher, that's not allowing everybody to excel at the same rate? And the problem is, it's not me, right? That's like when you break up with somebody, it's not me, it's you. It's not you, it's me. Okay, well, the same applies here. I'm conveying the information. Listen, I've had the same enthusiasm. Anyone that knows me, I love this stuff. It's an amazing business. But I have the same emotion, same excitement about it every single week. Day in and day out. I love it, right? Every day I'm excited about it. Some of you come in excited, your personalities are different, you see things different. And I drive some people crazy. I know that. They can't stand me going 100 miles an hour around them. They're just more calm, different type of demeanor. I understand all those things, but the bottom line is, the information is the information. I just convey it the way that I know how, or the way that I'm, I guess, built, my personality, and it comes out. But I can promise you this, that this is an easy fix to probably not just your trading situation, but stuff in life in general. And I'm not giving you life advice. That's not my job here. But I promise that my life got infinitely better when I became consistent in my behaviors, and I woke up, I feel good every single day, knock out some exercise in the morning, and things have just been better for me. So I realized the value in it by trying to figure out what the hell is wrong with you guys. All right. So how could you become consistent in his trading? All right. So all those things apply. Your behavior's got to be consistent. You got to feel the same every day. You got to show up every day, same time, show up, skip certain news events, all the same stuff that I just said. Okay. So now another way to take it to the next level is to remove one of my favorite sayings is the variation on the theme, right? It's SSDD in the trading business. It's just how they hit the stops, what they do, variation on the theme. The problem is, you can't have variations on the theme in your behaviors, right? So you have to take a very specific setup, whatever it is, right? This is just an example. Only trade flips after the high or low of the day is set in and retest the apex nadir. That's your setup. Only trade 50 bounce trades on the first touch through the 50 and back into it. Right? Limit the number of pairs you trade and know the pairs. Don't jump around. It's a huge problem for a lot of people. They don't see a trade, so they're looking for something. They got to get something today because they showed up. Got to take your profits at a fixed amount no matter what you think or feel. There's some people that were struggling to get 50 and they dropped down to 35, and it was a game changer for them. Why? Because if you know and done the measurements on your pairs, the impulse legs are between 30 and 35, right? With a X amount of pullback, level two's got a 50% pullback. So do the math. 35, 50% pullback is 17. Take the spread out, pulls back to maybe 18, 19. It's all math. If you sit down and figure out how everything works, you're trying to get your impulse. So how does it go? Hold on, let me see. Trying to get a pen. Okay, so we know there's 3 impulse legs, right? 3 pushes. Okay, you're trying to get in on this pullback area and execute into the impulse. Okay, this is worth some number in every pair. Euro's a little less than GBP. GJ is a little greater than pound dollar. So let's just, for argument's sake, say that the ADR is 100 and each impulse leg is 33. Okay, if you're trying to get 50, it means you have to sit through the secondary pullback and the repaint of the level. So if you cut your take profit to the approximate size of the impulse, 25, 30, 35, depending on the pair, you should see more take profits more rapidly, and that helps you emotionally, and it also gets you in and out of the market faster. Because this takes some time to develop. If you go through, every single impulse leg has a consistent number of bars. After the consolidation, right, you get a flat print, pull back, hit the stops, drop. This number is going to be 33. This number is going to be 33. That's 100 pip ADR roughly. Then you have to figure out where on these pullbacks you're going to execute. If you're taking one setup, which would be the anchor flip, right? The primary entry, then you need to be concern yourself with impulse leg one, right? Push one or leg down one. That looks like a 4. Hold on. L1 push. What is L1 push worth in the pairs that you trade? Is it worth only 28? Okay, if it's, for argument's sake, if it's worth 35 pips, you immediately subtract. Here, do the math with me. 35 pips. Okay, 35 pips, you got a spread on each side. Let's just say 2 pips. That puts it down. That's 4 pips, 31. The buy and the sell side spread, 31. Okay, now you have 31 pips to make an entry out in front of you. What if you're not that great at entry right now and you're getting a 5 or 7 pip removed from the absolute zero swing? Okay, so let's just say for argument's sake, you're getting in 5, 6 pips late, then your target should be 25, right? Not everyone is going to grab zero. Some of you are going to wait for confirmation on the side of the ketchup, or you're going to wait for whatever reason, maybe another micro pullback in here, and then you're going to get in. You have to understand what's left before level 2 paints and pulls back against you and puts you to break even. So it's structural stuff. It's math. It's structure and math. The market is structured the same. It's been like that for, I don't know, 22 years, 23 years. Nothing has really changed. It literally is SSDD. It's they hit the high, they hit the low, they hit the stops, they pull back, they paint, they make vector bars, Gartley's and harmonics paint on a regular basis. Price does what it does, and it's funny is you could roll back in time and just see all the same crap I've been talking about for the last 20 years. Go back to my early videos. The charts look the same. What's the difference? The players have changed, and the ideas of approaching it have changed. They've grown a lot. There's a lot of different ideas out there. You got to find something that sits well with you and that you can identify and see, and you got to be consistent in that behavior. It takes time, man. You know, I've been here a long time. Most people wash out in 6 to 12 months. I've been here 22, maybe 23 years now. And I've been looking at charts all the way back to FX Solutions, and I can't even tell you the platforms I've been with. A lot of them have come and gone out of business. Just a handful of big banks are still around. One of my favorite dealers was a company called Velocity Forex, and we took them for some money, and they went out of business. Alpara used to be around in the U.S. It's gone. I mean, I could go through. I couldn't even tell you the number of platforms. All right. So the bottom line, if you're struggling in the business right now, I'm talking to whoever, I know this is hitting somewhere. You need to look in the mirror and figure out what the problem is. The information is the same for 23 years. And really, I always bring this quote this from Jim. Jim has the Wellington bond market chart from pre-1900. I don't remember the exact year, 1875 or something. There's a big fat W sitting right in the middle of the chart right before they shook everybody out and destroyed them. So for what it's worth, the charts are the charts are the charts. It's your behavior and your reaction to what you see on the chart. And the way to fix that is the stuff I just covered. Take care of yourself, and the trading will start to take care of you. All right, let's look at some charts. Got a pop quiz for you. What I want you to do is give me some context on these charts. I'm going to pop some charts up. I want you to tell me what's going on. All right, just like take a minute on each chart, mark it up, and if you're lost, just kind of hang out and I'll talk about it. All right, you ready? I'll be quiet for, I don't know, a minute or so. A minute. All right, go. All right, what'd you get, man? Okay, a lot of you got it. All right, so look at the time down here. Okay, it's the rollover. 1700. London, right? Always look at the time. Okay, so this would be basically Asia, right? Hit the stops, catch the breakouts. 1, 2, 3 into the low. A huge buy bubble, absorption, stop it, dead. Price comes up, gets through the last swings. Right, here's your trade. 1, 2, long. Grab up lower level shorts. Use this ball, Pac-Man, to break through the liquidity. 50 bounce, VWAP, right? Breaks above, first touch. That's an entry too. And if you waited to get above that and above the liquidity, there's an entry there. All right, so look at these boxes. This is how I started drawing boxes around price. It's because the liquidity levels were forming boxes. So you had a bunch of liquidity. They triggered it, absorbed it, went back up, used this to get them through. They got the suck back. I always talk about. And then they use this to pop through the rest. And then they got another flip right here. Liquidity, right? You start seeing all these little places where price might stutter. And if you look over here, right, realize these candles printed, this would be a box right here. So you can imagine in your mind that if you get above here, you're going to get continuation. Right, so your entry is coming off of this lower level swing. Right, this supports price right here. I hate that word, but look where it came from. Isn't this, you guys know what pair this is, right? It's GBP. Same thing over and over. They always throw micro head and shoulders. They always false move it, pull back, hit it deep, come above, and then go after it again and stall. It's very common in this pair. If you just look for head and shoulders on GBP, there's enough opportunity there. Okay, what would be a secondary entry? This little flip right here, possibly, right? You get, this would be your level, and this would be your low swing. Right, so you got push 1, level 1, push, you got some pullback. You don't get as much a pullback on this. You get a break above this level, and then you get the suck back into the previous level. So this would be your 1, 2, and that's either an add-on or one more trade, and this runs out till the end of the day. Start looking at this stuff in this fashion. Start looking at it like this. All right, look at, draw this liquidity forward. See how it's in the book, it gets absorbed, and then they put it back in the book? Right, it's here, book turns black, no liquidity. They're through it, absorbed it, and then they put it back in there. So that means there's a possibility price could go here and go higher. You'd get a pullback to it. But also these levels, like this level here, these levels move up with price to keep it from coming back. So when you get these smaller pullbacks like this right here, I know you can't see it. Let me erase this. I want to make sure you can see it. It's important. When you get a smaller pullback, right, you get like push 1, push 2, push 3, right? Pushes, pulls back, pushes, pull back. When you get these smaller little pullbacks in there, and it's common, it means that this liquidity is following price higher. It's pushing, right? It's blocking the zone. It's blocking price. And if you look at how doesn't this look like a box? If you look at the way that printed, it's like ghosted into a little box. And this is not a lot of pips. If you look at this, this is basically 1, 2, 3 pips wide in the book. So you can easily see where if you would have executed a trade somewhere in here, right? Because draw this, look, a little tiny box. It closed above the last swing, right? Always ask yourself, where's the last place? In this instance, it would be sellers had control. Where's the last place buyers took control? Those are the low swings, right? The last place would be really technically here and here. So you get a push down, which is a failed sell side auction. They closed above this previous auction price here. They pull back, fail your swing, higher price. That's how you manage your trade. If you got in on this perfect entry right here on 0.2, then you're in. Now you start looking for ways to manage the trade. Price breaks higher, pulls back, failed swing, break higher. Price pulls back, failed sell side, higher. Price pulls back very small, doesn't even come close to going after the buy side, higher price. Price comes up, micro pullback, stops dead, not even close to taking out anything near the sell side swing, higher price. Now you're in the consolidation. This is the context you need to be looking at. You can call it a narrative, a story, whatever. Doesn't matter. This is the context that you're looking for. Okay, now you're sitting here. Last place, last place. What happens? They take out the high. You expect them to come back. Take out the high first. You expect them to come back, and they challenge the low. You get a little bit of a bleed, higher price. Not even close to coming after the buy side of the book, higher price. Here's the level. Here's the level. Take the areas of liquidity in your mind and box them up. How would that look? The areas of liquidity are going to be on the bar, right? I'm just going to draw a simple bar. Okay, simple hammer. What has to happen in this part of the book to help you to understand that? Okay, well, if price is laying right there, you probably got a yellow or orange line sitting right there. Why? Because price came down and got rejected aggressively, and the body opened and closed or closed right there. Right? If it's an up bar, it closed right here. So liquidity could have jumped up higher and pushed price, and there's some kind of stripe right here. And it's finding enough pressure to keep it higher and close it. Right? There's some number here, like it might look exactly like this, an orange and a lighter number, and rejects this pin and jams it all the way back up. The liquidity jumps with it as a bar. It does this same exact thing. This isn't a huge price run, but it does the same exact thing on a smaller structure for each bar, right? Because this would be a 1 hour bar. So it would probably look like this, right? Price gets pushed up, and as the bar is beating, right? You know how the bar just goes like, and then it closes higher. Or it opens and goes straight up, the liquidity just jumps the levels. It looks like this, almost stair-steppy, as it's pushing price higher. Everything you see, this is 5-minute chart, but it looks the same on a 1 hour chart. It's just as slower and easier to see it developing. So in your mind, think of the backside of the screen. What are these guys doing? How do I get a hammer? I get a rejection at the lows of the pin, and then they squeeze the body, which is the most part of the volume. They squeeze it higher and turn the bar inside out. So price opened here, turned completely red. Price opened here, turned completely red to the downside, met resistance from a large block of liquidity, and then the liquidity stair-stepped up and slammed on the body of that bar, turned it inside out, and closed here. You might get a bubble like that right here at the top, and then it jumps over and goes higher. That's what's going on in the book. Do you need the book to understand that? No, the print is enough. The book is very crazy and distracting. I don't look at it. I let it run in the background so you guys can understand. This is the context of how this whole market is developing. And the minute you can understand that, it's going to be a game changer for you. That's the key that's missing for a lot of people. You understand? You're missing some context in the stuff that you're looking at. And the only way to get the context is to visualize it from the other side of the screen. What are these guys feeding me, right? They're feeding you bullshit. Don't eat it. Understand it and beat it. Okay. What's the trade locations on here? I covered those. What would they be like? Time of day, always. London crossover, 3 pushes to the low, right? You had maximum absorption from a Pac-Man right there, right? They stopped that bar dead. One little stripe of liquidity. It was orange, and then they ate it up, and it faded into blue-gray. Right? You got to confirm on the close above the AR low swing. I showed you that. We had the AR level drawn in, right? AR, close above, ran the stops, came back, got back above the last swing point, actually here. As soon as they get above that, they got the absorption they need to move forward. It's like they eat up the orders to turn the book black and just easily get through it. Right? They had some consolidation off of the low back into the AR range. Strong close above the VWAP 50 EMA waterline. The 50 EMA is the same as VWAP. They print almost identical. And that's right. You flow with the water. If the water's pointing down, you should be taking shorts. I just mentioned one of the strongest trades. First crossover, tap back into the 50. That's a 50 bounce trade. Good for 50 pips. Why? If you take the first crossover, it's usually early in the cycle. First part of London, you get the cross. You hit the stops, drop, pull back into the 50, starts to paint level 1. You sell the bounce trade, and you follow it for 50-50, 50 pips. It's going to go at least, there should be more than half of ADR left. That's where that comes from. That's an anomaly in the chart we noticed 20 years ago. First touch to the 50. Carr turned it into a whole methodology. He has the rules. If you're struggling to find a way through, look up Carr's 50 bounce rules and make that your trade. You got to become consistent at being consistent. It sounds like all cliche. Steve, I heard this crap before. I'm tired of it. Okay, but if you're not making money, it's the reason. If you're not where you want to be, it's the reason. I guarantee you, if you tell me you're having a problem, I tell you this, guys, all the time. You hate hearing it, but I look up your digital footprint. How many hours you got in the forum? How many emails? How many charts have you marked up? How much stuff have you sent me? Some of you are suffering in silence, not necessary. But for the most part, I know what you're doing on a regular basis. And that's where the rub is. You're mad at me, but you really, because you don't want to blame yourself. No one likes to blame themselves. You want to point the finger. But you need to be mad at yourself for not being consistent. You're not showing up consistent. You're not consistently marking charts. You're not consistently watching and observing price action. You go in, you watch my class 4 days. You go in, you go, I'm pro now, and you start trading crap. You don't send me anything. You don't do any legwork. That's the problem. And I know you don't want to hear it. And maybe you don't take care of yourself. Maybe you show up at different times. You're sporadic. You sleep in. You miss your mark. I understand it's tough, but you're in a business. Do you like wake up late and go to your regular job? Do you show up same time every day? You sit at your desk, or whatever you have, the type of work you happen to do, you show up at the spot where you're supposed to perform your work. Okay, I told you I was a fireman for a long time. Loved the job. It was pretty crazy. But guess what? I didn't pick and choose when I went to work. I didn't go like, I think I'll go in at 3 today. It doesn't work like that. 0800 got to report for duty, man. And everybody was always early because you're relieving a guy that has a family, and he was there for 24 hours. So you show up 7:15, 7:20. And that's a courtesy that everybody gives each other. So you're the only one that doesn't have courtesy. You show up at 8:05, 8:30, 8:45. Can't do that. You can't show up in your office at 2:45 and go, damn, missed all the trades. Okay, what do I do now? I'll just start pulling the trigger and blame Steve. That's the difference. You got to make those little adjustments in your behavior that make you consistent. This is just trade location. Where's the best trades? I showed you them. So I forgot it was part of the quiz. I get excited. I love this stuff. All right. Late trade entry. That was the one I showed you that was very high. Was there any juice left? This is the question you got to ask yourself. If you get on a late trade, has ADR been met? Okay, this is what I'm talking about. This trade up here. A couple questions, qualifiers. You want to take this trade in here? These are the qualifiers. Right? The question is, has ADR been met or exceeded? If you're outside of the ADR or very close to the ADR, there might not be any juice left for you to get out of that thing, right? Less reward. If you're going for 50 and you're 30 pips away from the ADR, you might want to rethink your TP. Always look for a mid-level consolidation, right? You know, if you look at the moving average only lines, right? I love that, by the way, that everyone has the template in their folder. Moving average lines look like this. Then they should sideways print for a little bit. Maybe it's a session changeover between 6 and 8, 6:30 and 8:30 in the morning. You'll get a sideways print, then you'll get a hit the stops continuation. The averages will start doing their thing. You want to trade in the flat prints. You want to trade in the area where there's a flat print, right? And you can just look at the moving average template and see this stuff. You want to trade, your execution is in the flat print, always. Right? This we know there's a 50% pullback most of the time. You'll get this, you might get a cross, and then they go back higher aggressively. You should watch or observe the moving average only template, and it'll give you a rough idea of which way things are pointing. That template alone, right, it's kind of got like a brownish background and black. They're mixed. And they have I have different time frames made up. You just look at those and start observing the moving averages, how they interact. Forget about price. Just look on average, on aggregate, where's price going? How is it behaving? And then you could see just these lines, and you could start to fill it in with your mind. Okay, we know that if it sideways prints like this and drops a little bit, this is probably the W anchor. Then the moving averages open up, go back. This would be your 50 bounce trade, or this might be your bounce trade. Start looking at this stuff without any money on, and you'll start to have a better understanding of what's going on in the business. All right, so if you want to back fit or retrofit the count to get a higher level entry, you got to go, okay, where am I at? Okay, 1, 2, I'm consolidating at level 2. I should have a push. Market might go vertical on me for level 3. I'm looking for somewhere to get involved. Right? You either take a break above, pull back into the high, or you take a stop hunt low and hope that it vectors across and gives you that push. Right? You're looking for the A or V framework, and then you pull the trigger. Reduce your expectations, lower your TP, tighten up your stop a little bit, and go to break even as soon as you can, because you're chasing late price. Right? This is always the best opportunity on the board. This is the best opportunity on the board. After they hit the stops, go into consolidation, you're looking to get on board here. But if you're late, there's alternate opportunities here. We know that it does this, right? Fake M. There's an opportunity here. It's not as great as this opportunity. We're getting later in the day. Gives you something. Right, 1400, that's 2 in the afternoon. Realistically, I wouldn't take this trade, but I want you to see the alternate opportunities available to you. Okay, that's how you figure it out. This has a nice A-frame in it, so this would be your 1, this would be your 2, and you have, it goes up a little bit, challenges the stops. But look, if you're in the right spot, if you got the low swing, the low of the day or the low of that swing, same thing. Low of the day, low of the swing. High of the swing before you get a pullback. Low of the swing, high of the swing, pullback. Those are valid trades, but measure this from here to here and realize if you want to be done pretty quick, that the expectation might be 20 pips, and this might have been 75 pips on this run. Maybe you carved out an easy 50 out of this. Just do the math. If the stop hunt was 25, 30 pips down and the impulse leg is X, subtract those numbers off of there and then be realistic where you got in. That should be your target. Unless you're going to wait through this and then go into consolidation pullback and wait for it to run out to the end of the day. It's just fixing the little nuances or understanding the nuances and fixing your behavior. All right, do it again, man. Give me some context. Next chart. Ready? Man, it takes too long to talk through these, but I'm enjoying it. All right, ready? Go. I'll be quiet for a minute. Go. All right, same type of thing, right? Just the other direction. There's a beautiful bounce trade right there. Okay, so you got, look at the levels of liquidity, right? You got some capping going on in here, absorption, right? There's your insurance. Remember I told you they'll have a heavy level of liquidity and they'll have ain't nobody getting through this level. Dealer insurance. And it's always, you can count how many pips higher it is. So you got 1, 2, 3, 4, 5, 6, 7, 8, 9, about 9 to 10 pips away on average. Somebody just barely tapped into it and then they rejected it hard. They pushed it straight down flat. Came back, tapped it again. You got some absorption off of it. It turned gray, but then they put it all back. They filled the book back up, right? Not getting through here. And this is probably going to be the high of the day. All right, so same thing, box the stuff up, draw some lines, right? Look at how the liquidity is stacked. Okay, do you need to have the book to see the liquidity stacked or no? If you get a flat print turn bar and it goes down, you know that, well, damn, there was some orange lines right there. It stopped dead. Right? If you get a wick reaching into here and it goes all the way down and closes down there, do you need a book map to realize that that was a 10 pip wick and it got rejected hard? No, you do not. So you could essentially take, this is how I started drawing boxes, the top of the wick, the top of the body, and stretch it out in time forward. And drawing it just like that, I've managed to capture the high side blocking liquidity. Okay, same thing. I take this, stretch it out. I managed to capture the low side liquidity in the book. If the candles were here, it would be a better drawing. So now what? Okay, they rejecting higher price. They break below. They close below the liquidity level, and then they curve back up and retest. This would probably be an AR50 trade, perfectly, and a bounce. So your zone would be mid AR in the 50 bounce line. And you could kind of get a rough idea right here by drawing this out, right, wherever the wick is, and you get that retest. This would be your 1, this would be your 2. Sell that into that. If you wanted to be more conservative or got there late, this is a secondary entry. Right, you have your push in, pull back, push again, failed swing, failed buy side auction, flip. Failed buy side auction, flip. Failed buy side auction, flip. Very little goes into consolidation, end of day. Okay, so you had 1 trade, 2 trade, 3 trades, and then a scratch because it did move away from that area enough maybe to scratch. Right, but again, time of day, 1400, it's 2 o'clock, you're late. The action is here. This is late to the party. There's a filter on the book, right? And you could take out what I call the noise. And I took a picture that I wanted you to see the same exact thing and understand what's going on. All right, so this is noise on, this is noise off. So what happens is you adjust the slider on here and you can take away the smaller order blocks like the whites and the yellows, right? You could basically phase them out. So I was hoping this would help you understand the context. So if you look at it like this, you have the swing high, right, and the swing low where they blocked it. If you draw these out forward, you notice how the liquidity follows and they retest into these areas, right? They absorb this, they push lower, and they came back to it. And just so happens that the volume weighted average price is there, or your 50 EMA is right there. That's a bounce trade. This would be a bounce with a lot of bleed. And you may have gotten stopped on that. But this is a really good bounce continuation right there. Notice something kind of crazy. Shoulder, head, shoulder. Can't even make that stuff up, man. It's perfect. All right, and then you look at a little bit bigger context. This could be a shoulder, head, and this could be the shoulder over here. Can't make that up, man. It's right there. So what happens? They're trying to get higher prices, right? And then they get the accumulation here, then they trigger the stops and they go through it. Then they try to drive price back up, get everybody go long, and that's how you paint the shoulders out. Every time you see a V or an A, the frames, right? You have to understand and give it context. If you have the right directional bias, this in your mind is a V, not an A. Understanding the directional bias from a higher time frame, if it's trading above or below the watermark. Flow with the water. That's from our late great Ted. Really good guy. He's part of the group for a long time. He passed away. But his favorite thing was, I like to flow with the water, baby. That was his deal. This is your directional bias intraday. This is your directional bias intraday. Look for interaction with this number. If it rejects, right, this probably printed in some type of pin bar. If it rejects higher price below the 50, you're sell side. So what do you need to be sell side in this example? Anchor high, cross through, tap back, lower price. Okay, a long one would be anchor low, cross through, tap back, higher price, and the average will curve with it. If you don't know what the hell I'm talking about, look at the moving average only templates. All right. Tell me what this Pac-Man comes from. Why is he there? All right, ready? 10 seconds. Tell me. Maybe. Maybe. Okay. Who else? Yep. Maybe. Okay. Anybody else? All right. You guys got it right. Some of you didn't even take a stab at it. It's okay. I'm on, right? You can hear me. Okay. All right. So why do you have a massive Pac-Man? Why do you have a massive Pac-Man and price falls? I said it last week. Okay. It's no new money. It stops. Okay. How could you have a massive buy block and price falls? No new money. What do I mean? If people sell into a possible reversal, when the dealer, right, if people are selling, the dealer has to trigger the stops. So he gets people induced short, pull back against them. In order for a green bubble to execute on a sell side of the book, it's no new money. It's passive money coming in. It stops. If you are a seller, the exit of the trade is a buy. If you are a buyer, to exit the trade, you sell. Okay, so price doesn't go up, but you have a massive buy block, a Pac-Man, hitting at that price, right? whatever the number is. And by the way, I never really care about this. These numbers on the side doesn't mean anything to us. It's irrelevant. Whatever, $1.32, $1.13 doesn't. Who gives a shit? The only thing that matters is if it's like really out of whack and you're trying to buy a loaf of bread or a gallon of gas. That's the only thing you should care about. But if you're trading this, the number is irrelevant. The behaviors. I've been drawing this stuff for 20 plus years. It's the same every single day in and day out, week in and week out. So if you get a heavy buy block, then you know that the stops were triggered. But how do we know that the stops are triggered? Because you get a picture that's going to look like this, right? You're going to get a perfect M. You're going to get a pullback into this area on the chart. This would be your little box. What's it going to look like? You might get this, a hammer that goes all the way up and gets rejected when this thing fires and price gets pushed all the way back down and continues lower. All right, so you have full absorption of the stops against retail traders. I'm almost out of time. I had an audio clip for you of what they call the time and sales. It has a, I really don't even know why it does it, but it announces the orders coming in. And I have like what the retail trading order flow sounds like, and I'll play that for you next week. It's just weird, like it's a robotic announcement of how many lots were sold or bought, and it goes on for, I mean, it's infinite. It goes on all the time, and the market's moving. And then you can see the difference in, like, they call it pace of tape or speed that the orders come in. And at certain times of the day, there's barely any orders trickling in, and then it's very fast and loud and like huge blocks coming in. And I wanted to play a clip for you, but it's already 53. I'm out of time. I don't want to get on to the next topic. So, all right, so here's where we're at. Wrap it up here. I need you guys to get re-engaged. We're in the second quarter. It's underway. We're moving along. You've got about 10 weeks left till we're looking at the summer, and like 4th of July, that's the perfect ending for the quarter. Take a few days off and then get back at it. Summer typically gets a little slower, but there's a lot of activity, and there's always, these patterns are 24/7, round the clock. They're always there, man. There's always opportunity. That sell in May and go away doesn't really apply to Forex. There's activity and there's enough movement to keep things going for your career. All right, so what do I need? Send me some plans, send me some ideas, send me some excuses. I don't care. Tell me, hey, Steve, my dog ate the homework, or you know what, I got some stuff going on in my personal life, but I still love you. That's what I'm here for, man. Drop me a line. Let me know what's going on with you. Let me know, hey, this Bookmap stuff's driving me crazy. I wish you'd get on with something else. I need to know where you're at. All right, I appreciate every one of you. I love the group. I love the business, and I hope you could catch fire and feel some of the enthusiasm that I feel for it. Hope everybody's doing okay. I hope your life is going well. Don't forget, I'm here for you if you need anything. Send me something. Good night.